G'day Gains Squad, it is so good to have you back here on the Goldie Gains channel today. Let's see where the smart money is flowing today as we break down a massive 3-day trading window. We are covering the energy shock at the Strait of Hormuz and why oil prices are absolutely vertical right now. We will also dive into the Reserve Bank of Australia's shock rate hike and the carnage on the local exchange. Plus, we are looking at the new gold-backed trade system from the BRICS nations called the Unit. Quick disclaimer for the squad, I am an analyst, not a financial advisor, so do your own research. Legends. The main big question for today is, can gold stay above $5,000 if the US dollar keeps ripping? Tell me your price targets for April in the comments, and let's see who among us is the most accurate. If you want to stay ahead of the curve, make sure you hit that like button and subscribe for more. Smash that bell icon so you never miss an update when the market is having a bit of a wobbler. First up, the breaking news from the Persian Gulf has the entire global market looking very shaky this week. The Strait of Hormuz is effectively closed to commercial traffic, and that has removed 20% of global oil. This geopolitical shock is the primary driver of volatility across every single asset class we track in our portfolio. Traders are pricing in a much longer conflict than we first thought, which is keeping the safe haven bid strong. Even with the planned release of strategic oil reserves, the physical supply gap is a massive structural problem. The market is now in a state of high alert as we wait to see if the waterway reopens. This uncertainty is a textbook case of why we keep a core allocation in hard assets like physical gold. When the energy grid starts to feel the pressure, the smart money always looks for an exit into bullion. We are seeing a proper flight to safety as the risk of global stagflation becomes a very real conversation. This is the most complex trading environment we have seen since the start of the year, hands down, legends. Let's look at the oil prices, because West Texas Intermediate crude is acting like a total firecracker right now. On Monday, March 16th, WTI crude fell 4.7% to $92.46. But then on Tuesday, March 17th, the price surged back up to $96.73. This massive $4 swing in 24 hours is precisely why the OVX index is so chock-a-block. The CBOE, Crude Oil Volatility Index, or OVX, has been sitting at extreme levels well above 100. An OVX at 100 means the market is expecting daily swings of 4% in oil prices. For us gold getters, this volatility is a double-edged sword that creates a massive inflationary tailwind for the metal. High energy costs are flowing through to the price of everything from diesel to groceries and even mining labour. This energy nexus is the engine behind the current move, and we have to watch those crude charts daily. If oil breaks back above $100, expect gold to catch a very aggressive bid from institutional traders. Now, back to home soil, because the Reserve Bank of Australia just gave us a proper shock on Tuesday. On March 17th, at 2:30 in the afternoon, the RBA hiked the cash rate to 4.1%. This was a 25 basis point increase that almost nobody in the market was actually expecting this month. It was a very close 5-4 split vote among the board members, which shows real internal drama. Governor Michelle Bullock noted that inflation is re-accelerating and the energy price shock has forced their hand today. This move has pushed the cash rate to its highest level since October of 2011 legends. The RBA is worried that the Middle East conflict will keep local fuel prices high for much longer. They have maintained a hawkish bias, suggesting that another hike could be on the cards by May or June. This has sent the local rates market into a frenzy as traders reprice their mortgage and business loan expectations. It is a tough pill to swallow for the economy, but the central bank is focused on killing inflation. The domestic impact of this hike was felt immediately across the Aussie dollar and our local share market. On Monday, before the hike, the ASX 200 fell through a key technical threshold of 8,600. The index closed at 8,583, which was the lowest finish of the entire year. The materials sector took a massive hit, plunging over 2% as gold and iron ore miners slumped. Gold miners like Regis Resources and Bellevue Gold were sold off heavily as cost inflation hit their profit margins. Financial stocks were the only bright spot, adding 0.4% as banks benefit from higher rates. It is a classic defensive rotation where investors are hiding in staples and utilities to weather the storm. To negate this technical damage, the ASX 200 needs to reclaim 8,771. Until that happens, we are likely to test the support levels down near 8,400 very soon. This is the kind of environment where you want to keep your positions tight and your eyes wide open. Over in the currency pits, the Australian dollar has been doing some serious heavy lifting against the greenback. The Aussie dollar pair was remarkably resilient during the oil spike, but it has turned very choppy lately. On Tuesday, after the rate hike, the Aussie dollar tested levels above 0.7090. However, the gains were short-lived as the US dollar index, or DXY, hit a 10-month high of 100. The DXY is capturing a dual tailwind from safe haven flows and the prospect of higher for longer US rates. This creates a massive headwind for the Aussie dollar as it struggles to stay in its bullish channel. On the weekly chart, we are seeing a shooting star pattern, which often signals that a top is in. Bearish momentum has picked up over the last 48 hours, so the 0.70 level is crucial. If we close below 69 cents, then the carry trade might start to unwind very quickly for the traders. It is a balancing act between the RBA's hawkishness and the global rush for the safety of the dollar. Let's look at the gold price action from March 16th to March 18th because it has been intense. On Monday, gold opened near $5,020 but faced a heavy wave of paper market selling. It dipped to a low of $4,967 before finding a floor and bouncing. By Tuesday, March 17th, we saw a nice recovery high of $5,044.50. As of today, Wednesday, March 18th, we are sitting right around $5,001 an ounce. The market's having a bit of a wobbler because traders are selling gold to raise cash for margin calls. But don't get it twisted, because physical demand from the central banks is still providing a massive bedrock. Every time gold drops below 5,000, the smart money seems to step in and sweep the floor. We are essentially consolidating after that historic run-up we saw in the first 2 months of the year. This sideways grind is actually healthy, as it resets the technical indicators for the next leg higher. One major structural shift we have to talk about is the BRICS nations launching the unit pilot. The unit is a gold-backed digital settlement instrument designed to bypass the Western banking systems entirely for trade. It is anchored by 40% physical gold and 60% by a basket of local currencies. This allows nations like Russia, India, and China to settle oil and grain deals without using US dollars. This is a massive step for de-dollarization, and it makes gold an active trade asset once again. Legends. The alliance now controls about 50% of global gold production, which gives them serious leverage. As the unit gains adoption, the demand for physical gold reserves will only continue to scale up globally. The People's Bank of China has already been on a 16-month buying streak to back this new system. They have amassed over 74 million troy ounces of gold to ensure the unit has real, tangible backing. This is the long-term fundamental story that makes every short-term dip look like a gift for the squad. For the gold getters, this shift toward asset-backed money is the ultimate validation of our investment thesis this year. We are moving from a world of trust-based fiat to a world of collateral-anchored trade settlements very quickly. The unit isn't just a research project anymore. It is becoming a physical constraint for the old dollar system. As dollar liquidity requirements drop, the value of the underlying gold collateral is only going one way. This is a once-in-a-generation realignment of how value moves across the planet, and we are front-running it. Let's talk about the US Federal Reserve, because their meeting this week is the final piece of the puzzle. The market is pricing in a 92% chance that the Fed holds rates at their current level. However, the updated dot plot and the press conference from Powell will be the real catalysts for gold. If the Fed signals they are worried about energy inflation, the dollar will likely rip even higher from here. But if they acknowledge the weak jobs data, gold could see a massive relief rally back toward the highs. We are essentially in a holding pattern until that decision drops later today in the US session. Smart money is reducing position sizes right now to avoid getting chopped up by the initial volatility spike. I am looking for a clean breakout or a rejection at $5,040 to define the trend. Remember, when the Fed blinks, gold usually vaults, so keep your alerts set and your eyes on the screen. This is a high-stakes week for the macro environment, and we are right in the thick of it, squad. The sentiment on the forums is also reaching a boiling point, with retail traders fighting the institutional shorts. Some legends are calling the recent drop to 4,900 a massive bear trap for the weak hands. They are betting that the real move is up once the Fed uncertainty is finally cleared from the desk. Meanwhile, the short sellers are stacking limits at $5,037, hoping for a deeper correction. It is a proper tug-of-war between the paper market and the physical reality of the energy crisis right now. We have to remain disciplined and not let the noise of the daily candles distract us from the trend. The structural forces of debt, war, and de-dollarization are far more powerful than any single interest rate hike. Gold has already gained 16% this year, and it is just getting started in this new regime. We are looking at potential targets of $6,000 before the year is out if this continues. So keep your heads cool and your pouches ready for any opportunities that the market throws our way. Let's optimize this entry with the latest technical analysis across the daily and 4-hour charts today. Gold is currently sitting right on its 20-day moving average of $5,009 per ounce. We are seeing a massive Bollinger squeeze, which historically means an explosive breakout is brewing very soon. The daily relative strength index is sitting at 46.93, which is a perfectly neutral reading. Our MACD is showing a slight sell signal at -1.78, so play it safe. However, a long-term golden cross is still active as we stay comfortably above the 50-day moving average. Support is firm at $4,980, but a break could lead to a slide. This is a proper golden entry for anyone looking to build a long-term position in this bull market. The technical structure remains constructive as long as we don't lose that 4,900 floor. To recap, oil volatility is extreme, with the OVX index hitting levels well over 100 this week. The RBA has shocked the market with a hike to 4.10% in Australia. Our local ASX 200 hit a yearly low of 8,583 recently. The Aussie dollar is fighting for its life near the 0.70 mark against the dollar. Gold is holding the $5,000 line while paper traders flush their leveraged positions for quick cash. BRICS nations are pilot testing the unit as a gold-backed digital settlement tool for global trade deals. And the technical charts show a massive Bollinger squeeze that is ready to pop for a big move. Now, do you think gold can hit $6,000 before the end of the Australian winter legends? Let me know your thoughts in the comments and tell me how you are playing the RBA hike. Make sure to like and subscribe to the channel so you can keep those Goldie gains coming in. Keep your positions tight and gains golden. I'll see you at the next close. Cheers.